Today's guest says he lives for moments like this. We're in stock market, economic, global chaos, confusion, and turbulence. And here to make sense of this for you is today's guest, Rick Rule. He is a legendary and famed commodities, natural resource investor, and has been through many of these turbulent markets, and he'll be helping you and I make sense of it here. So if you enjoyed today's video, make sure you hit the like button. Bell notification is what notifies you for new videos, so make sure you hit that. Special shout out to our sponsor, Vizsla Silver, one of our favorite silver and gold mining stocks. So thanks, Vizsla Silver. Comment down below, Rick Rule rules. If you enjoyed today's video, almost got a tongue twister right off the bat there, Rick. So how you doing?
Life is great, Jake. Thank you for asking. As noted earlier, I'm happily failing retirement. And as you suggest too, these sort of market conditions where volatility and fear are the sort of overarching emotions are just very, very, very good times for an old veteran like myself. Markets where everybody's overconfident and overpaying for everything are markets where there's not much for me to do. You know, if you compete with dumb money, you are dumber money. But the truth is, you're seeing companies that were financed a year ago at $300 million valuations that are now selling at $110 million valuations. And people who would happily pay $300 million for them seem to be unwilling to pay $110 million. From my point of view, this is extremely attractive arithmetic, and it's just going to get better. So if it seems like I have sort of the catbird smile on, it's because I have the catbird smile on.
Now, at the end there, you said, quote, and it's just going to get better. So you are expecting more turbulence to come. We've seen the 10-year move. People are wondering that the debt markets, the credit markets, the stock markets, where do we go from here, especially with your last words you said, and it'll only get better from here?
Well, we're in a risk-off market. And I'm a guy, among other things, who likes some risky assets. If there's a situation where there's an asset class that I like, junior resource stocks is an example, or emerging and frontier market stocks, where the overwhelming sentiment is negative. What that means is that sectors that I know extremely well are going to go from cheap to extremely cheap. You won't feel necessarily very good about your existing inventory, but to the extent that you add inventory, you're going to feel fantastic about it. The last time that you and I talked, Jake, I don't know if you remember this, but I said paradoxically that although I cut my teeth and had my expertise in small cap and micro cap stocks, that they were overvalued relative to large cap and mid cap stocks. That's changing, and it's changing very, very, very rapidly. So we're coming into a circumstance where the expertise that I built up over 50 years of investing and speculating is those lessons are going to be lessons that I'm able to employ, which is extremely attractive to me. Volatility unnerves most people because most people only pay attention to the price of their investments. That price information isn't worth anything if you don't have a sense of value. In other words, if a stock is selling for $1, what does that mean? If you think it's worth $2, then the fact that it's selling for $1 is cheap. If you think it's worth 50 cents, then the fact that it's selling for $1 makes it expensive. Most people pay slavish attention to price information and have no opinion whatsoever as to value. So, of course, during periods of volatility, those people that don't have the courage of their convictions, because they don't have convictions, will make mistakes. And those mistakes will inure to the benefit of people who are psychologically and financially prepared. And I'm hoping I'm both.
You talked about the difference between price and value, and we've been in this really big funny money game for a long time that's built this giant debt bubble where all asset prices seem to be, in some sense, reflective of this infinite money printing in this debt bubble. And the messages seem to mix all the time, from whether it's the television or the government or the Fed. now it's the end of the bear market. Now it's not the end of the bear market. And then you see the 10-year treasury starting to move as well. And so I guess I wonder, in accord to the price versus value, where is the true bottom, and do we head there before the Fed reverses course? Where do you think it goes from here when you have like 10 out of 11 last weeks and the overall market's been red, and then the 10-year spiking, and now they're saying they're not going to print more money? I mean, what happens, right? Because you and I have talked before about, I made the argument that this investing right now is different than like when you were in the 70s and 80s, because there's just so much more debt. And how much longer can the funny money game continue?
I think the funny money game can continue for a fairly substantial period of time. I don't think that the average investor and saver in the United States is as afraid as he or she is going to become. I believe that most people still believe that the big thinkers have their back. I'm not sure that I believe they have my back, but that doesn't matter. I don't make a market. I think in the very near term, we're probably set up for a technical rebound. I think equities are oversold. I think bonds may be oversold because although I think they offer a horrific value proposition, they are regarded by other people as safe havens, irrespective of the arithmetic. So I think in the very near term, we may see a rally. To me, that feels like a sucker rally. Higher interest rates do two very bad things to debt and equity markets. The first is that they raise the issuer's cost of capital. You know, if you're somebody paying the prime rate and the prime rate is 3, your cost of funds is 3. And if the prime rate goes to 4, your cost of funds went up by 33%. Obviously, your margin is the difference between your costs, including the cost of capital, and what you sell your product for. But the other thing that increasing interest rates do is they reduce the value of existing income streams. So if you own a U.S. 10-year treasury, which you bought a year ago with 125 basis point yield, and today the U.S. 10-year treasury is selling for a 225 basis point yield, over 10 years, what that means is that your income stream is worth substantially less. Similarly, if competing savings products begin to yield appreciably more than the dividend yield of the S&P 500, as an example, there's going to be disintermediation by income investors from equities and from bond funds into other deposit products. So clearly, if you believe that interest rates are going to continue to rise, in the intermediate term, you believe that long-term bond markets and conventional equity markets are going to continue to suffer. My own particular belief is that at some point in time, it may be a year from now, it may be 2 years from now, that the impact of higher interest rates through the economy is going to be problematic enough that the Fed and the politicians will lose their nerve, which is to say that my bet is that they turn around quantitative tightening and go back to quantitative easing, and they begin to manipulate interest rates down. And when that happens, I suspect that it's really, truly game on for inflation-oriented instruments. If you think about the logical conclusion of what the Fed is trying to do right now, and by the way, I support it, the higher interest rates. But if you think about the logical conclusion of it, one wonders if they might have the courage to let it continue. Let's look at the arithmetic as an example. In the U.S. 10-year treasury, assuming it's yielding 230, 240 basis points right now, it's yielding 230 or 240 basis points in a currency which is losing purchasing power at 8.6% compounded, which means that even at today's higher interest rates of 2.3 or 2.4, the average person is losing almost 6% a year in purchasing power. We've laughingly referred to that on your show as return-free risk. And so it's likely that over time, there will be selling of that sort of instrument as people get tired of losing 6% compounded. But the impact goes further. Traditionally, by traditionally, I mean over the last 4 decades, most of the time, the US 10-year Treasury has sold for a positive real yield. A positive real yield with the CPI stated rate of inflation is at 8.6 would suggest that the US 10-year Treasury, if it reverted to mean, would have to yield 9. If it yielded 9, you would quadruple the cost of capital charges at federal, state, and local government levels. Imagine the impact on your municipal budget or your state budget or our federal budget if the interest expense increased 4-fold over the year 2021. I suggest that might be untenable. But if you really want to have fun with the numbers, Jake, traditionally over the last 40 years, the US 30-year fixed mortgage rate has traded at a premium to the US 10-year Treasury, which itself has been positive. So if inflation is at 8.6 and the Treasury reverted to mean at 9, that would suggest that the first mortgage rate, the 30-year fixed mortgage rate, would have to be at 9.5 or 10. Imagine what would happen to home affordability. Imagine what would happen to people who are in variable rate mortgages. The point of all this is that the political class and the Fed are really truly stuck between a rock and a hard place. They need to let interest rates rise, if for no other reason, so that they have a tool to lower them later when the economy becomes less robust. But they can't let them rise too much, because if they let them rise too much, consumer durable sales, which is to say automobiles, or shelter, which is to say homes, or that whole range of things which are bought on credit, become, from the point of view of most taxpayers and most voters, unaffordable. So we are truly coming into an interesting time, Jake, and I'm looking forward to participating in it.
Well, you summed it up quite well. I guess the question is, at which point do you think they do reverse? You said maybe they'll rise if for no other reason than to reverse, because people, obviously inflation isn't going down while they're doing this. So they're simultaneously sapping out the majority of people's wealth, which is in their 401k, their IRA. If the housing market collapses, the same thing. It'll just be a total, So then the question is, at what point do they stop? I guess is like the question everyone's wondering, right?
I hate to sound arrogant, but I think focusing on when misses the point, simply because you'll never know when. I think what you have to do is you have to live your life with the sense that there is no necessary answer to the when question. And you have to conduct your life in prudent fashion. Despite the fact that you lose money having cash, you have to have some cash, because cash will give you the tools and the courage to handle volatility. It sounds counterintuitive when you understand that cash is costing you money, but there's an opportunity cost associated with having cash. In a risk-off environment, the price of asset classes which you would normally want to hold for the next 5 years, which is to say precious metals as an example, gold and silver, get soft. And if you don't have the courage of your conviction, it's easy when the gold price falls from 1900 to 1800 saying it's going down and selling it, really truly snatching defeat from the jaws of victory, mistaking volatility for arithmetic, which is a mistake. Similarly, if the S&P 500 is going lower, but if you have specific knowledge around a company and why that company is attractively priced, the fact that a company, that is to say an investment that you know well and feel good about, is becoming less and less expensive is a benefit to you, not a cost to you. And if you buy a stock that you think is worth, let's use a big cap stock. Let's say you think something is worth $50. And the stock is selling at $40, and you're planning on holding the stock for some period of time longer than a long weekend, because you believe that the company's prospects are such that it will do well over the next 5 or 10 years, The fact that it fell from 50 to 40 is a benefit to you. If you can't think in those terms, the best thing to do is to become extremely conservative, which is to say, hold cash, hold precious metals, and have very, very, very low expectations. Or maybe simply pay off your debt and hunker down. That isn't what I'm proposing to do. I'm proposing to take advantage of the situation as opposed to being taken advantage of by the situation.
So are you buying now, or are you waiting to see how high interest rates rise? What is someone that hears you and says you're talking about opportunity? There's opportunity. How do you know when to strike at that opportunity, and how much longer do you think there's room for a differentiation between price and value?
Jake, my gut feeling is that the market goes lower, but there are some values that are so compelling that I can't help myself. I remember about 2 years ago, maybe a little longer, after the COVID thing shut down travel, and where the greatest thinker in the world with regards to energy was a 16-year-old Swedish teenager, Greta Thunberg, where Exxon got thrown out of the Dow 30. And the price of Exxon absolutely collapsed. And I remember Exxon was selling at a 12.6 or 12.7% dividend yield. Now, it was very obvious to me that people were going to drive their cars for the next 30 years, that Exxon wasn't going out of business, and that a sub-zero price of oil wasn't going to last. And I made a critical mistake. I thought Exxon was going to go lower. And I missed the opportunity, at least for 45 days, of buying the best asset allocator in a business that I knew well, because I thought it might get cheaper. I'm not making that mistake now. Where companies are selling at substantial discounts to what I believe the net present value of their free cash flows are going to be over the next 5 to 10 years, or when they're selling at big discounts to what I think the risk-adjusted probable value of their assets are, I'm going ahead and buying stocks. I have been thus far unsuccessful, unfortunately, in negotiating private placement financings in microcap equities, because the management teams at those companies believe that the market is going to magically get better in the near term, and make other sources of capital more competitive with me. But Jake, I'm highly confident that in 2022, the people who are playing chicken with capital markets when they need capital are going to lose, and I'm going to win.
Why are they going to lose and you're going to win? Because you think we're going lower and there's more of this playing chicken with
Yeah, I do. You know, I'm competing right now with $50 million or $100 million hedge funds run by 20-something-year-old gunslingers. Those gunslingers are going to lose their nerve. Their investors, when they're showing a 40% loss for the year, are going to pull their capital. The last 3 years in the private placement business has been, if you were willing to do it, competing with dumb money. And if you're competing with dumb money, you're the dumbest money on the planet. That dumb money, as we speak, is going to money heaven. And the absence of the people who have driven the microcap mining market, as an example, in the market means that capital is going to be more scarce, and therefore that returns to check writers, or at least the terms that one speculates on, are going to improve, probably markedly.
Okay, I hear you. So, what happens to commodities? You've said before we're entering or are in a commodities super cycle. Take aside gold and silver, whether it then look at commodities across the board, whether, we obviously, you and I have talked a lot about uranium. What happens in an environment like that for commodities and mining stocks, especially if it's in a commodity that has already, we'll take, for example, like uranium, that has such a supply demand deficit? What happens in an environment where if the S&P goes lower and we enter this big recession and the Fed tries to keep waiting because they want interest rates to get a little higher before they hit the gas and go all the way back to zero the other way. What happens to like commodities like that and mining stocks like that? And what's your advice to people investing in that?
I think you have to do that commodity by commodity. With uranium, you started at the commodity that I'm probably over the next 5 years the most bullish about. The stuff is selling for about $50. The cost of existing production, the fully loaded cost of existing production, is about $60. I'm not talking about mining cost. I'm talking about total cost of capital, G&A, prior year write-downs. So right now, the industry makes the stuff for 60 and they sell it for 50. They lose $10 a pound, and they do that 120 million times a year. Pretty boring. Meanwhile, utilization of uranium on a global basis continues to increase. Many people don't know this, but we use more uranium now than we did pre-Fukushima. We're using about 200 million pounds a year, and we're producing about 120 million pounds a year. So with regards to uranium, the price of uranium has to go above the cost of production, the total cost of production, or the industry self-liquidates and the lights go out. More importantly, given the size of the producing deficit, you have to look, rather than at the total loaded cost of existing production, you have to look at the incentive price for new production. Somehow we have to make up this 80 million pounds of deficit. And the incentive price for new production, given the inflationary pressures in the mining development cost curve, the price of things like cement and oil and steel and labor and things like that, is such that my suspicion is that the incentive cost for new projects is somewhere between 70 and 75 US dollars a pound. I believe that the price of uranium must increase from $50 a pound to some price north of $75 a pound. And it may go substantially higher because even if the price does go to $75 or $80 a pound, you can't bring on new production quickly. So with uranium, I'm probably uniquely bullish. Does that need to happen in a period of time that suits investors' psychological needs? Of course not. It might easily go from 50 to 40 before it goes from 50 to 75. But certainly in the 2 to 5 year time frame, the price of uranium has to go from 50 to some number like 75, or the lights go out. My suspicion is, and it's just a suspicion, that it happens sooner rather than later for two reasons. One, my former employer, Sprott Inc., where, by the way, I'm still the largest shareholder, has a product called the Sprott Physical Uranium Trust. And we have, on behalf of investors, bought 55 million pounds of uranium and made them no longer available to spot market purchasers. So the spot market, the overhang that existed in the spot market post-Fukushima, has begun to dry up, if for no other reason than Sprott. But the second thing, which is more important, is that there's an increasing realization around the world that non-carbon generating baseload electricity is an important thing for humankind. In China, as an example, the Communist Party has said that 500,000 people a year in China die from airborne particulate pollution as a consequence of power generation. They don't want to kill 500,000 people a year, but more particularly in Japan, where the popular political winds were decidedly anti-nuclear as a consequence of the Fukushima disaster. The popular political winds now are uniformly pro-nuclear, which means that sooner rather than later, that portion of the Japanese nuclear power fleet, which has been shut down, will be restarted. It's important because that isn't new plant construction. A new reactor, which is on the drawing boards today, may contribute to uranium demand 10 years from now or 12 years from now. But a restart contributes to the uranium demand in 2022. So of all the commodities you've discussed, the one that I'm the most certainly bullish about in the 2 to 5 year time frame is certainly uranium. In I'm sorry, Jake, go ahead.
Before you go on another commodity, just to wrap up on uranium, does the psychology of the market and that need to recover for uranium to move, or due to the very unique fundamentals you expressed in the face of this, can you see it move, or does there need to be an overall recovery first?
Oh, my hope is that there's a washout. Given that I think the price is going from 50 to 75, I really, really, really hope that many of my competitors who don't really have an opinion, at least an opinion grounded in study, make a mistake and sell. There is nothing that would make me happier than the 12 uranium stocks, which are on my buy list, getting slashed dramatically in price, particularly the microcap companies that will need to come back to market to raise money to put themselves in a position to take advantage of increasing prices. So for those of your speculators who are fair weather friends, which is to say, for those people who prefer to pay more for an asset than less, this will be a very, very, very hard year. For value-oriented contrarians, those of us who are temperamentally pawnbrokers, this will be an extraordinarily good year. I think where the price of something has to go up, but it doesn't have to go up immediately, I'm competing with a whole range of people who are emotionally or narratively active rather than arithmetically or scientifically active. And I look forward to that competition, Jake.
So you were going into other commodities. I don't know what you had in mind before I cut you off, or what happens to oil? I mean, does it just...
Well, oil's a great question. Right now, there's two oil markets. One is global production and the other is Russian production. And the Russian production, because of sanctions, is selling for about $30 below the international price. My suspicion is that the near-term price in oil is lower. Why would India, as an example, want to pay $30 more for oil when they could get it for the Russians at a $30 discount? But interestingly, the oil stocks are selling on a net present value basis as though oil was selling at $70 US. And more importantly, they're selling as though natural gas were at $4.50 US cents, as opposed to $8 or $9. So the oil stocks are already pricing in a substantial discount to the oil price, which I think we're going to see. What's unique in the oil and gas sector that I haven't seen for a very long time is, despite the fact that producer cash flows are at record highs, and despite the fact that refining margins, at least in the United States and Europe, are the highest in living memory, the industry isn't reinvesting the free cash flow. In the case of refineries, because they can't get permits to build them. And in the case of upstream, which is to say oil and gas production, is that at the same time the legislature tells the oil companies to produce more oil and invest more money, that same political infrastructure, the Bidens of the world, are saying, we're going to make this business cease to exist in 2030. Why, if you're Exxon, would you invest $50 billion when the legislature says they're going to put you out of business? So we're in this weird circumstance where the industry is generating a ton of money. But rather than reinvest that money in production, which would bring prices down, they're increasing returns to shareholders by way of dividends and share buybacks, which means that it seems to me like the oil price will stay firmer for longer than it would if the market was allowed to operate under its own volition. There is an estimate right now that the oil industry on a global basis is deferring new project and sustaining capital investments of about $1.5 billion a day. And this deferral of sustaining capital investments, if you're in a business where your existing fields deplete on a year-by-year basis, almost guarantees that on the supply side, oil supplies stay tight. It's very worthwhile to note when you look at OPEC, the fact that traditionally there's been a substantial amount of cheating with regards to OPEC, which is to say they establish quotas and then various countries violate the quotas. You have a situation now where there's only 2 or 3 countries in OPEC, that have the ability to outproduce their quotas. And they don't have an incentive to outproduce their quotas because they're nervous about the political realities around the popular opinion, at least the politically popular opinion, that oil and gas companies should go out of business. So I think it's a very, very, very attractive market, even at these levels.
So when you explain it like that, then it makes me wonder, okay, so what do they do with all their capital they're making? Does it become like the stock buybacks of the tech stocks that we went through, or what happens to oil stocks?
That's what's happening right now. They're doing three things, really. They're paying down debt on their balance sheets dramatically. Although debt has historically been very cheap, there's less and less debt capital available to the oil and gas industry. So the oil and gas industry is strengthening their balance sheets in real time, really, really, really dramatically. They're increasing dividends, and they're doing stock buybacks. In other words, they're returning capital to shareholders and strengthening their balance sheet rather than reinvesting. What you need to do as an investor is pay attention to companies whose capital plans are balanced, which is to say, despite the fact that the industry isn't reinvesting substantial amounts in the business, there are individual companies, ExxonMobil being one, that are investing substantial amounts of money back in the business. You want a company that isn't in liquidation, that isn't raising its dividend enough, that it is in effect liquidating itself in real time. You want a company that's reinvesting at least enough that they'll maintain production volumes, reserves, and resources over the course of a decade, while also paying attention to their balance sheets and the needs of their shareholders. Mercifully, because the oil and gas business has been through so many tough years, right now, the chief executive officers, the chief financial officers are extremely disciplined, extremely well-intentioned. And what you're seeing is very, very, very good behavior on the part of the industry.
So you gave us some places that you're looking at, that you're excited about. You gave us a breakdown of where you think we're at and where you think we go from here. Could you end us with a couple tools that I'm going to need, that someone listening to this is going to need for this unique moment of time that we're in?
Discipline. It's important that investors make their first investment in themselves. One of the reasons years ago, Jake, why I decided to be interviewed by you, somebody that didn't have very much background in financial services, was that your own background was in self-help and education. And what investors are going to have to do is learn a lot more about the investing process and learn to manage their own psychology to become better investors. If you think something's going to go up in price, you would love it to go down first so that you can buy more. For some reason, investors seem to prefer the psychological validation of seeing prices go up. In other words, for some weird reason, people seem to want to buy physical assets cheaper and financial assets more dearly. That's wrong. So investing in one's own knowledge and then investing in one's own discipline, not requiring immediate gratification, is what investors have to do. Investors need to be prudent with regards to their balance sheets too. Despite the fact that you lose money having cash, you need to have cash. From my own point of view, when I look at where our governments are and when I look at where the feds are, what you need to do too is own physical precious metals. I'm not saying that you have to own it at home. I'm not saying that you ought to engage in midnight gardening. But I think that owning physical precious metals in some form, either certificated form or in physical form, is insurance. I think you do it. Yes, I think you're going to make money. In fact, I think you're going to make a lot of money. But I don't think that's why you do it. I think you do it to avoid losing purchasing power, to provide for yourself and your family over time. And I think that investors who see, let's say an investor thinks that silver might outperform gold over 5 years or 6 years. I'm certainly of that opinion. It's odd that an investor who thinks that he or she needs to own more silver gets absolutely unnerved if the price of something they want to buy goes down. In other words, people seem to have a psychological aversion to sales, which is insane. I think you need to develop a fondness for sales rather than an aversion to sales. For those of your listeners who are accredited investors, that is to say, have $1 million plus portfolios and have some degree of sophistication, I think the next 12 to 18 months might yield a real plethora of private placement investment opportunities after what I've seen as a 3-year desert where I was competing unsuccessfully with dumb money, which is to say where the sector was so grossly overcapitalized that I wasn't adequately rewarded for providing much needed capital. I think that party's come to a screeching halt. And my suspicion is that we're coming into one of those 12 to 18 month periods where the terms and conditions that are offered up in private placements, when you think about monetizing them over the 3 to 4 to 5 year time frame, are going to be unbelievably attractive. My suspicion is that the next 12 to 18 months will generate opportunities that over 4 or 5 years will produce literally dozens of 10 baggers, 1,000% gains. And 1,000% gain with a full warrant turns out to be an 1,800 or 1,900% internal rate of return. So for those investors who can take the risk inherent in private placements and restricted securities, I think that we're coming into a particularly attractive time.
Awesome. Thanks so much, Rick. For everyone listening, I want to thank you. Rick, I'll link his website right there down below. Rick does a free natural resource review of your portfolio, which I'll link in the description. Rick, am I missing anything?
Yeah, 3 things I want to say. The first is, if you care what I'm doing with my own money in terms of private placements, when you go for the portfolio review, I should repeat that. I'm happy to review anybody's natural resource portfolio personally. Go to ruleinvestmentmedia.com, list your natural resource stocks. Please no crypto, please no tech stocks. I'll review those 1 to 10, 1 being best, 10 being worst. If you care what I'm doing with my own money and you're accredited, write placements. Note too that in retirement, I'm starting a new bank. If you aren't happy with your own bank, either as a depositor or a borrower, you might want to care about mine. In the comment section, write bank. Finally, for 28 years, I've put on investment conferences and various investment products. We're doing another one in Boca Raton, Florida, July 26th, 27th, 28th, 29th. If you would like to come to my investment conference or you'd like to learn more about it, in the question and comment line, write conferences. Note that this, like all of my investment products, my educational products, has a full money back guarantee. If you come to the conference and you don't think you got your tuition worth, write to me, ask for a refund. We'll give you a 100% tuition refund, no questions asked. So once again, I'll rank your portfolio. If you care about my bank, write bank. If you care about my private placements, write placements. If you care about in-place, face-to-face educational products, write conference.
Beautiful. We want to thank you, Rick, and we want to thank you for listening today. If you enjoyed today's episode, make sure you hit the like, subscribe, bell notification, give us a comment down below. This is Rick Rule Rules, and we will see you